My name is Ron Lake. I'm from Lake Partners. I'll be the moderator for today's Greenwich Roundtable, which is an ongoing series of investment seminars. I want to thank Altbest for sponsoring the Greenwich Roundtable, and also thank Nick Benning of Indian Harbor for helping organize today's event. Steve, any announcements or comments I want to make before we start? Today's topic is behavioral finance, irrational markets, and the search for value. In thinking about today's topic, I was reminded of a joke that Woody Allen used to tell. He talks about he complains to a friend of his that his uncle is really getting on his nerves because his uncle thinks that he's a chicken, and it's hard to take them anywhere. The restaurants are embarrassing. And his friend says, "Well, why don't you take him to a shrink and get him cured?" And Woody Allen says, "Well, because I eat the eggs." And I think about this topic and asking the question, why do markets behave the way they do? Why do investors behave the way they do? Aside from eating the eggs. I think that our three panelists today will have a tremendous amount of insight into a very basic debate between two schools of thought, one being that markets are rational, markets are efficient, markets and investors are well informed. The other school of thought being that no, in fact, markets can be very irrational, inefficient, and investors can be very ill-informed. So with that as background, let me introduce our three speakers for today. Sitting next to me is Robert Shiller, who is the Stanley B. Razor Professor of Economics at Yale University. He is one of the pioneers of this field of behavioral finance, and among various responsibilities, a member of the academic advisory panel for the Federal Reserve Bank of New York. He's written widely on financial markets, macroeconomics, real estate, stat methods, behavioral economics, and public attitudes towards markets, and has a new book out called Irrational Exhuberance, which just made the bestseller list for nonfiction books of the New York Times, and a book that also won the Common Fund Prize of this year. Next to Robert is Richard Geist, who is president of the Institute of Psychology and Investing, which he established to provide consultation services to brokerage firms, money managers, financial planners, and other kinds of companies in the areas of management, psychological stress, the impact of psychology on investor performance. And he publishes and edits a microcap market newsletter, Richard Geist Strategic Investing, which includes a column on the psychology of investing. He's also the co-director of the Harvard Medical School's annual Psychology of Investor Conference. And next to Richard is Allan Turner, who has a long career of 37 years in the financial markets as a practitioner, as a trust portfolio officer, a buy-side and sell-side analyst, and also head up the St. Regis Paper Company Investor Relations Program from 77 to 84. In 84, Allan founded his own company, Stock Management, and among other things has been responsible for investment policy of the Coastal Corporation. So without further ado, let me turn it over to Robert Shiller to introduce our topic and get his perspective on these issues.
Okay, well, originally Dick Thaler, my colleague, was supposed to be the first speaker. He didn't show up, so I was substituted as first. I take the academic perspective on behavioral finance. Well, one of the academic perspectives. Dick Thaler and I have been organizing at the National Bureau of Economic Research regular conferences among college professors about what we call behavioral finance, which means the psychology of financial markets. But I've heard about these Harvard Medical School conferences. I've never been invited, and I've never seems how people are academics tend to move in groups that never communicate with each other. So I'm glad to meet you finally. This kind of is part of my motivation. I've always, in the university community, been struck at how the different departments all have their own course and rarely communicate. And it's particularly striking to me how the economics department has no communication with the psychology department, or the sociology department, or the anthropology department, or the history department. And it seems to me fundamental to good work that we take into account the insights that different, and the medical school, different branches of inquiry have. So that is my motivation. I believe that economic theory, conventional economic theory, is extremely valuable. However, they don't take enough account of the other social sciences, like psychology. When you talk to psychologists, even the term behavioral finance kind of reflects our. When you talk to psychologists, when they hear the word behavioral, they think, "Oh, that's B.F. Skinner. That's a branch of psychology." And we have to tell them, "No, we don't know anything about psychology. So for us, behavioral sounds like psychology as a whole." By way of discussing that, I'd like to talk first about my own recent book called Irrational Exhuberance, which it's a scholarly book, but it's in many ways a popularization of behavioral finance. I believe that in order to get a broader public interested in this field, it's important to tie it in with a national event or some concern of people. And so the book is built around the current level of the stock market, which is a source of concern, obvious concern to many people. And what the book does is analyze the current stock market situation from the standpoint of both conventional economics and behavioral finance. As you know, the title of this book comes from Alan Greenspan. It was in a talk he gave in December of 1996, in which he used the term irrational exuberance. Actually, it was a question, if you remember. He said something like, "How do we know if the financial markets show irrational exuberance?" Despite the fact that it was such a nebulous statement, it was a question, stock markets all around the world dropped sharply, immediately. It was swept across first Tokyo, Hong Kong, and then Frankfurt, Paris, London. So why did people react to that statement? I think it's because a lot of us, maybe most of us, maybe all of us, are concerned about the idea that some kind of investor psychology has been driving the markets. And yet, most of us, in kind of an ambiguous state about that. We don't know whether we believe that or not. I feel that it hasn't been shown one way or the other. So what I decided to do in this book was to write an authoritative treatise, as authoritative as I could make it, arguing the case. And I have a position to take on it, that irrational exuberance is actually a very good term to describe what is going on in the stock markets recently. So I actually argue in this book that this is a national policy issue of great importance, because the overpricing of the market is affecting our decisions. It's distorting economic decisions in many ways. It encourages people to invest too much in new startups and business expansions, and maybe too little in other things like our own personal human capital or education or preserving our own jobs. We have the sense that we're all rich, or that certainly we're going to be rich later, that the market is going to continue to will make us all, investments all do very well, and as individuals we will all retire as millionaires. That's an unfortunate illusion. It also, among things that people, the savings rate is very low now. People are borrowing against their houses to buy stocks. And we're neglecting some of the important issues about, I think of the Social Security debate today is really a debate about how we as a society are going to share our risk. But it's viewed from some quarters as that the question is, should we take advantage of the stock market? I'm not accusing George Bush of taking such a simplistic stand, although sometimes it sounds that way. And his proposal is actually quite moderate, apparently. But there is an element that thinks that the stock market is the solution to all of our problems. So I actually began work on this book in 1987. The timing wasn't as good back then. The market crashed on me while I was working on it. I decided then to do something different, which is some academic research about that crash. I sent out a questionnaire survey to both individual and institutional investors, asking them, what were you thinking on that day, and why did you buy or sell on that day? This is a line of research that is remarkably rare. It's always puzzled me why nobody asks people why they did something. Economists will tell you, well, Milton Friedman, for example, that nobody will give you a straight answer, and they can't even explain why they do things, so we just have to look at their actions. Well, there may be some truth to that, but it seems to me odd that nobody asks. It seems to me that maybe people can often tell you why they did things. So it turns out I was the only person in the world who did a questionnaire within a week of the crash and asked those sorts of things. So what did I conclude? But it may sound too simple, but what I concluded was that a major element in the crash was a feedback loop, people's reactions to price changes. That prices started going down, people saw them going down, so they decided to sell. That caused prices to go down further, and so on. I embellish this, of course, in some more detail in my report on this, but the first thing is that people were not reacting to any news. Well, of course, maybe a better way to say it is they were reacting to all news, as they always do. I asked them about specific news stories, and they blandly said that they're all important. But when I asked them to write essay questions a little about why were you doing something, they never mentioned any news, hardly ever. They mentioned what they thought was going on. They said, I couldn't get any answers, no one could explain, there's some crazy psychology going. So many of them decided to sell. So that's a downward feedback loop. And I argue in the book that what we've seen in the markets in the last 5 years, or going back, you might say since '82, is an upward feedback loop as price increases have lured more people in. That's not the whole story, but that's an important part of the story. So in the book, the first thing that I do is it's got structured as an argument about a detailed argument about the current market. I first present a comparison with past historical episodes. Then I talk about what I call structural factors. The first thing is precipitating factors. What's different in the market today or outside of the markets that ultimately caused this? And then I talk about the amplification mechanism. The feedback loop is as a way of amplifying the effects of the precipitating factors. Then I talk about cultural factors. The news media, I argue, are fundamental to any speculative bubble. And then I talk about new era economic thinking. Whenever there's a speculative bubble, there is some experts who will tell you that we're entering a new era where the economy will be better than ever before. Then I talk about psychological factors, psychological research that shows the limitations of human judgment that are important in the propagation of bubbles. I talk about herd behavior, which is a very important thing that we tend to act similarly. And then finally I argue against the market efficiency theory and the theory that the market is high because people have learned something. And finally, I discussed what individuals, institutions, and the government should do about the market situation. So I just want to go through, I can't go through all these points, but I want to just go through some examples from each of these sections of the book. The first thing is, how does the current situation in the stock market compare with past situations? Well, the simplest thing to point out is that the real inflation-corrected S&P index or the Dow both tripled in the 5 years from 1995 to 2000. That's to the peak. They tripled to a record high level in 5 years. Incidentally, the NASDAQ went up sixfold over the same time. But I'm talking about a broader index. When else in American history has the aggregate stock market tripled to a record level in real terms? Well, there's only one other time, and that was 1924 and 1929. So I don't mean to say that we're headed for the same disaster that we were then, but in many ways, the situation in the markets are similar to that of the 1920s. So we're in and incidentally, earnings have done well, but not nearly so well. If you look at a plot, I have in my book a plot of both real stock prices and real earnings since 1871. And earnings seem to be a little bit above trend, but nothing so spectacular. And prices have just taken off like a rocket. It's just an incredible shift in prices. And people, often they don't see that because they don't look at inflation-corrected stock prices. And they get the high inflation of the 70s looks like another stock market boom, but it's not as nuts. So the next thing then is, why is it, if the stock market has shot up but earnings have not, what has done this? And in this section, I argue that there's no simple answer to this. We're talking about a major historic event. And if you look at other historical events that have attracted interest of scholars, there usually is not a single, simple story of why it happened. Rather, if you read about these events from historians, you'll find that they tend to list many factors and argue that the event occurred because of the confluence of many factors. It's unfortunate that history is so complicated. If you read Gibbon's Decline and Fall of the Roman Empire, you don't come away with a one-liner about why it happened. And neither will you come away with a one-liner about why this current stock market boom is so dramatic. So in my book, I list 12 precipitating factors. And I would just give you the first one now, that maybe the most important one, and as an example. And that is the invention of the World Wide Web. That came, as you remember, in 1994 with the Mosaic browser and then the Netscape browser. That is really just about the time that the stock market really shot up. So what is important about that? Well, one thing that is important about it is a significant technological advance. However, if you look at the history of technology, there are many other technological advances that have occurred in U.S. or world history whose importance is arguably greater. It's hard at least to see why the World Wide Web would outshine them all. Think of the railroad, the automobile, or trucking, the airplane, the radio, the computer, the television. Many examples like that are created fundamental restructuring of our economy and were very important inventions. What is different about the World Wide Web? Well, it's a user-friendly device for linking computers. What is really striking, I think, about it is that it encourages participation by so many people. It's something that you spend hours a day on. It's called hands-on experience. Or what psychologists say, learning by doing, which is the most fundamental form of learning. You are actually doing things on the web, so you appreciate the importance of it. I think it was this and the random association of the of the web introduction with the recovery from the recession of 1991, and then the long business expansion, which created growth in profits unrelated to the web almost entirely, because the web hasn't been making any money yet. But it creates the impression of a new era. Amplification mechanisms. Well, I argued already about feedback, but I just wanted to give some evidence about the consequences of the feedback. And the consequence is that people are have high expectations for stock returns and also high confidence. Confidence in the market is at historic highs. In 1989, I asked in a questionnaire survey of high-income individual investors the following question: if the Dow were to drop 3% tomorrow, what do you think it would do the next day? And in 1989, the answers were, the choices were go up, go down, or stay the same, or don't know. In 1989, the fraction who said up was about the same as the fraction who said down. In other words, they had no idea what it would do the next day. You might say that's the correct answer, because if you believe in the random walk theory, you're not supposed to know what it's going to do the next day. But when I asked the same question in 1999, it was 3-to-1 up versus down. So that now people really think that it has to rebound. So all the stories you hear about buy on dips as a philosophy of investing are right. People have changed their minds, and they now believe that there's a strong tendency for reversal. It's also an incorrect belief, because still it looks a lot more like a random walk than would be suggested by those answers from day to day. So what I think has happened is that since 1982, it's really been that any major dip has been reversed. Notably, the 87 crash was reversed. And the experience, and many people watch the market day by day, the experience of seeing it actually apparently rebound from dips has created a strong psychological impression. And it's something that has become intuitive and deep in our consciousness. Cultural factors. The news media, I argue, are essential to any speculative boom. The financial markets generate thousands of prices, millions of prices, and the data which comes in every day in the newspaper is mind-boggling. People don't know what to make of it. The newspapers tell a story. They're in the business of attracting attention and telling a story. The human mind is much more attuned to stories with human interest than they are to abstract data. The news media then create a kind of mental mindset that alters and encourages the feedback. New era thinking, I mentioned before, every time there's a speculative bubble, that you have a new era story. Right now it has something to do with the internet or computers. But if you look back at other times in history, there were always impressive sounding new eras. It's very instructive, new era theories, and it's very instructive to read some of these, because you had writers operating in 1901, 1929, 1966, which are the three main stock market peaks, who could be very convincing that the economy was entering on a new era. Psychological factors, what I refer to here are not panics or euphoria, but errors in judgments that are characteristic of people. I'll just mention a couple. One of them is anchoring. Psychologists have shown that when people are asked to answer very ambiguous questions, they tend to anchor their answers on whatever number comes to mind. There's a famous experiment by psychologists Kahneman and Tversky in which they asked people difficult questions. One of them was, what % of African nations belong to the United Nations? But before you answer that, they said, we're going to spin this wheel of fortune. It's like one of those game show wheels that produces a random number from 1 to 100. So they spun the wheel, and they said, okay, what's your answer? And they tended to give answers that were closer to the number that came up on the wheel. I think the same thing is happening today. Nobody today knows what the Dow should be. Should it be at 4,000 or 14,000? We're prepared to believe anything the market comes up with. And once we've seen it, it sounds about right. The second thing is overconfidence. Now, psychologists have documented that there is something called an inferiority complex. There are some people who think that they are below average and have no confidence in themselves. However, psychologists have also shown that a far more common syndrome is the overconfidence. The overconfident people outnumber the underconfident people. We all think, most of us think we're above average. And it's important that we do, because if we didn't, most of us wouldn't want to trade. But if we really had rational judgments of our own abilities, half of us would conclude that we're below average. And those of us who are below average wouldn't want to trade with the other half, right? So there'd be no trade. I think that a very interesting human characteristic is overconfidence in kind of intuitive judgments. People feel very strongly that they know whether the market is going to go up or not, even though they disagree on this. But it's because the intuitive judgments are very deep in our psyche, and ultimately the plausibility with which that stories or theories have is informed by our underlying intuitive judgment. The last thing I wanted to mention about psychological anomalies is attention, and this is that if you think back about the biggest errors that you have made as an individual, they probably have an inattention aspect to them. Usually, when we make errors, it's because we're not paying attention to something. And attention is, of course, an important psychological mechanism that is basic to intelligence, but it's not perfect. One thing about attention is that it has a social component, so that we tend to pay attention to the same things that others are, and we are neglecting the same things that others are. So, as a society, there's a very pronounced tendency to watch the same thing. So when the O.J. Simpson trial was on the news, not all of us, but a great many of us were watching that. It's kind of remarkable how much that. And then Princess Diana came in. She died, unfortunately. And then the news media lavished attention on that. And it works. And we're neglecting other things. Well, right now, with the stock market, we're going through a period of enormous attention to the stock market. And it's palpable. You must feel it in the air. I play a game with my wife when we're eating out. I say, I'm going to keep one ear cocked to the next tables around to see when the stock market comes up. And it almost always comes up. So it's really on our attention. Now, what to do? The obvious thing, of course, I believe, is that the conventional advice that you should invest in the market, you should diversify over stocks, and then buy and hold for the long term is wrong. That if the long term is defined as 5, 10, 15, or 20 years, the market is probably not going to do well at all because it's so overpriced now. There might still be, obviously are still investments in some stocks that are going to do well, but you have to be selective. I think that, the final thing I wanted to say about what to do is refer to plans that I've been trying to launch to create new markets, to allow people to invest more widely. People will complain that they invest in stocks because there is no other. They say it's the only game in town, it's the only investment. I think we have to expand our financial markets. This is my 1993 book, which I have to just make a quick allusion to. We have to expand our markets to allow people to invest more widely in other things that are not currently investable, such as real estate, single-family homes, around the world. I'd like to see people able to invest in them, and also to hedge and spin off their own risk by shorting their own real estate markets. Moreover, we should have markets for national incomes, for claims on national incomes. It's a mistake to think that when you invest in the Nikkei that you're investing in Japan. It ought to be possible to invest in Japan and also to hedge your own risk, and finally to have markets for claims on occupational incomes. Anyway, my firm, Case Shiller Weiss Incorporated, tried very hard. I'm the Shiller in the three. Tried very hard in the early 90s to get futures markets started in residential real estate. We had the CBOT almost agreeing to do that, but they backed out. So now we're trying to create, maybe someday we're hoping to create securities that allow people to invest in real estate, or other more imaginative things like occupational incomes or national incomes. So I'll stop with that.
Thank you very much. Richard, give us your perspective.
Well, I certainly agree with Bob that people don't communicate with each other. Not only have we not communicated with Yale, but within Harvard we can't even communicate between the medical school and the business school. No one talks to each other. And I think if we're going to begin to understand the psychology of investing, we're going to have to expand our horizons and really bring in more of an interdisciplinary group of people who look at the market from different perspectives. One of the things I've been doing over the last 7 or 8 years is interviewing individual and institutional investors, asking them, and I have not used any questionnaires, so this is all qualitative kinds of research, but asking them how they make decisions about investments. One example of that is at Putnam, for example. I interviewed all the analysts at Putnam and asked them about their biggest mistakes and what the psychological underpinnings of those mistakes were from their perspective. I've also done that with hundreds of individual investors. And over the years, one of the dominant themes that has come up from everybody is that it no longer depends on how smart we are, how many degrees we have, how much experience we have, whether we use technical or fundamental systems. What really matters is how we handle our emotions at the time of buying or selling investments, and how we respond to what others are doing in the market. And the general consensus from the feedback I've had is, in fact, and I agree with Bob, that the internet is changing the psychology of investing, for better or for worse. And that change doesn't mean that this time is different in the traditional sense implied by those who are naively optimistic or complacent. There's still going to be bear markets, there's still going to be bull markets, we're still going to have business cycles, we're still going to have relative periods of deflation and inflation, although they may be lengthened in nature. But when fundamental valuation methods change, again for better or for worse, when market volatility increases, when 1 out of 2 retail trades is done on the internet without a broker, when e-commerce begins to shift the way a whole culture does business, when investors in different parts of the world can communicate in an eighth of a second, when more and more investors assume a trading mentality, all of those factors have to impact on our emotional state when trying to make investments. And although I won't discuss it today, these factors also have a dramatic effect and impact on how institutional firms market their products and how we begin to structure the relationship between advisors and advisees. But what I'd like to do this morning is to tell you something about the psychological underpinnings of how both institutional and individual investors have told me they make mistakes, because I think there's some important factors that we can learn from here. And also it sheds some light on why the whole investment scene seems to be changing in the internet age. There have been lots of arguments in the literature and outside of the literature on rational markets and irrational markets, and whether people are rational or irrational and how they make decisions. And I think behavioral finance has gone a long way to helping us understand that markets are certainly not as rational as people used to think, and that when we make investment decisions, we are not like the proverbial Mr. Spock in Star Trek, unemotional, unencumbered by relationships, and rational and logical in our thinking. It just doesn't work that way in the real world, and every investor, at least privately, will tell us that. We all have, so we're neither rational investors nor irrational investors. What we are is subjective investors. In other words, we all have access these days, because of the internet, to the same information. And there's a plethora of that information, and a lot of people are overwhelmed by the amount of information that's available. But we all have idiosyncratic lenses through which that information is filtered. And those lenses, which I like to call psychological organizing principles, enable us to filter that information and then interpret it in particular ways that leads to certain decisions. And one of the things that's been most helpful for investors is to begin to understand our own subjective organizing patterns. I'll give you an example of that. A money manager bought a small company called Mytech Surgical. This was a number of years ago, at $18 a share. She then watched the stock go to $25. After that, the company announced that they were changing how they were going to use their sales force, and they were transferring their sales force from an outside group to an inside group, and they were taking charges, and earnings would be hurt for 2 quarters, they predicted. With that, the stock dropped to 13. Cindy, the money manager, wanted to sell all her shares at that point. When we talked about it, and Cindy had an incredibly good understanding of the fundamentals of the company, which in essence hadn't changed. But what was making her wanting to sell at that point? What was making her want to sell at that point, as she understood it, was one of the filters that she used to understand data. And we all have these. Her organizing lens went something like this. When something good happens, something bad is sure to follow. And those psychological organizing lenses help us determine all our decisions. And we all have them, and most of them are unconscious. For Cindy, that particular organizing mechanism was becoming much more conscious. So she realized that, in fact, Mytech Surgical had played out through her organizing pattern. If something good had happened, the stock had started to go up. Something bad had happened, and it crashed. So therefore, she should sell. Once she realized that she was operating according to that organizing pattern, she went back to her fundamentals and didn't sell. And in fact, Mytech was bought out 6 months later by Johnson & Johnson at $30 a share. Another very common error that both institutional and individuals make has to do with anxiety. The amount of information, the volatility in current day markets creates enormous anxiety. Whether people admit to that publicly, I can assure you through the hundreds of interviews I've done that they do admit to it privately. Now, what happens when we experience anxiety? There are 2 important things that happen. One is, I like to call jigsaw puzzle thinking. In other words, when we're going to make an investment, we generally look at something holistically. We try and get as much information as we can from as many different perspectives as we can. When we experience anxiety, that holistic way of thinking changes. And what we tend to do is pick 1 or 2 variables to make a decision on. We forget about our holistic view of what caused us to buy or sell stock to begin with. So, for example, institutional investor bought Express Scripts at its IPO price of $13. the stock went to 30 very quickly. And then there was a corrective phase as the stock consolidated, and it fell back to 20. The individual wanted to sell his holdings in that stock. What he began to focus on at that point, again, having had a very comprehensive understanding of Express Scripts and the pharmacy benefit group, was the price and the volume of the stock. And the price and the volume of the stock would have told him to sell. The fundamentals of the company and the industry would have told him to buy more. He sold out at 20. As many of you know, Express Scripts then went on to over $100 pre-split. He couldn't imagine why he had gotten rid of his holdings in Express Scripts. And yet it was very clear that that decision was made on the basis of a couple of factors which had nothing to do with a holistic way of thinking. And the more we understand the symptoms that represent our anxiety, and they can be physical, they can be cognitive, they can be emotional symptoms, the less we fall into that kind of trap. The other thing that happens when we feel anxious is that our thinking processes tend to regress from logical, rational ones to more emotional ones. In other words, if I said to you, tell me the first word that comes into your mind when I say the word mother, your first reaction to that is not going to be the words that you would find if you looked up mother in the dictionary, because mother is an emotionally loaded term. And therefore, your thinking process would connect words and thoughts via emotions rather than logic. And when we feel anxious, that's exactly what happens. And that's why in this era of the internet, it's so easy for people to be taken in by internet chat rooms and the media, because we feel anxious and we begin to think and connect our thoughts via emotions rather than logic, and we act on those much more quickly. Another primary reason for mistakes has to do with the connection between our self-esteem and the market's performance. You know, when a 4-year-old jumps off the couch and says, "Look at me, I can fly," he or she is holding oneself up to get some kind of feedback as to how that 4-year-old is growing and developing. When we make an investment, we are on an adult level holding ourselves up for some kind of validation and affirmation that our intellectual judgment or emotional judgment is sound. And when the market goes against us, there are a number of reactions that tend to occur because there is an injury to our self-esteem. One of the more humorous and sad examples of that is from a well-known analyst from a major brokerage firm who lowered his rating on a stock from buy to hold. And when I asked him what caused him to lower that rating, he said, the company's earnings came in 3 cents under what they led me to believe and predict the earnings would be. And they really screwed me. They had no right to do that. And just to get back at them, I'm going to put their stock on hold. Now, obviously, the reasons that came over the wires were much different from that, from the private interview. But while he was putting on hold, his brokers were buying the stock for their personal account, but institutional and individual investors were selling it off. Later on, he came back with a strong buy on the stock. But it was the effect on his self-esteem and the feeling injured by management that caused him to lower the rating on the stock. It had nothing to do with anything rational. And this happens over and over again in the market. And in fact, investors listen to those analysts because investors and all people need experts to look up to and to merge with. I had dinner with Warren Buffett yesterday. That makes us feel good. He told me that because we're connected with a looked up to other that people admire. And one of the things the internet economy has really promoted is more and more of that kind of herd behavior, because it's much easier to connect with people in chat rooms and via electronic communications, and it's almost instantaneous. So there are lots of ways that I think this economy is causing people to make mistakes, and that's one of the reasons that some internet stocks, not all of them, become so overvalued. But having said that, I also think there's been a dramatic change in investing, optimistic actually about the future. And here's probably where I disagree somewhat with Bob. I think that today, despite the fact there are lots of mistakes made, investors are in fact more educated about the stock market than ever before. If you look back 10 years ago, there was not a business radio talk station in every major city of the country. There is today. And people are calling those stations 24 hours a day. It's not only that they want to speculate. People indeed want to learn about investing in the market. They have to learn about the market because there is no other way currently that baby boomers, are going to be able to retire or send their kids through college. So there is an effort to learn about the market. Investing, admittedly, has become a cultural phenomenon. I agree with the restaurant story that you can hear people at the next table talking about the stock market. Taxi drivers are talking about the stock market. And the traditional thinking is whenever that happens, we're in a speculative bubble. I'm not sure, despite the fact we are in some stocks and in some areas of the market in a speculative bubble, that in itself means now that we're in a speculative bubble, because people are indeed trying to learn about it. They've found out that the market can be fun, it can be intellectually challenging and emotionally challenging. It is the equivalent of sports in this society at this point. Time will tell whether that's something positive or negative. We also have a group of baby boomers who are in fact growing older. What happens to your sense of time when you go older? It goes more quickly. If you ask a child how long something is, it's often very slowly. If you ask an adult where time is going, once you pass 40 or so, time begins to really move quickly. No one has really studied people's sense of time, either from a psychological point of view or from an economic point of view. That has a dramatic effect on how people invest, because when your sense of time increases and it goes quickly, you have an inordinately higher sense of tolerance for risk. In other words, when time is moving slowly, you feel when your stocks are down that you're in the doldrums forever. When your sense of time is moving very quickly, you do not feel that this is going to last forever. You're much more likely to buy on the dips. You're much more likely to sit through corrections in bear markets. And I've been predicting since 1993 that investors, baby boomers, would not abandon the market in the face of severe pullbacks. And so far they haven't. Even in this severe crash, we have not seen a lot of redemptions in terms of what people expected. In fact, last week, a couple of weeks ago, was the first week that we saw some significant redemptions from aggressive growth funds. Otherwise, money has been pouring into this market, and people have been sitting on the sidelines, but there have not been redemptions. There's trillions of dollars sitting in money market funds waiting to come back in this market. People also have gone from investing in the market to niche investing. In other words, if you look at Michael Jordan, he had the skills to be a great basketball player. When he tried to play baseball, he was an average baseball player, and he came back to basketball. Baby boomers in this market are not investing randomly. They are investing in areas, in niche markets that they know. The people that originally invested in Amazon were people who understood technology and had some notion of how the internet was going to affect this economy. There were only at the beginning 5% of institutional investors in Amazon. The rest was all retail. And if you had the good sense to get out when Amazon was at $600 pre-split, you would have made a lot of money. It was not pure speculation, although there were a minority of people in Amazon who were clearly knew nothing about anything. But there were a lot of people in it who understood technology before the rest of us understood technology, and they made a lot of money. And I think you're seeing that more and more in the baby boomer population of people finding a niche they understand and sticking with that niche. We're also seeing, because of the internet, much more interpersonal investing, what I like to call interpersonal investing. In other words, if any of you have read Lowenstein's book on Buffett, he describes in there, not using the psychological language, but he describes the symbiosis between Buffett and Munger, and how, in fact, the two of them work together, enhancing each other's understanding of certain aspects of the market. Because of the internet, because of more communication between people, there is more of that small group and partnering investing. And what you find, or what I found from my interviews, are that kind of interpersonal investing produces better returns than individual investing, and it produces better returns than large group investing. So I think we're going to see that continue. I think we're going to see over the long run the over $10.4 trillion, which is coming into baby boomers over the next 20 years in the form of inheritance money, going into the stock market. Baby boomers love the stock market, they need the stock market, and they want to be in the stock market, and they're going to learn as much as they can about the stock market. So I'm running out of time here too, so let me stop there.
Thank you. Allan, do you have a point of view? Please share with us.
I can't resist, since Dr. Thayer didn't show up, hoping that it wasn't because he was guessing or thinking that we might be rethinking the money we put into his firm. But let me also do one other thing before I get into the speech, because I want to give everybody a question that I want them to answer themselves, either at the Q&A or later. Let's do an SAT test, A, B, C, D. A, which one of these speakers, after you hear my speech, is more like Charlie Brown? Which one is more like Linus? Which one, maybe neither, none of the above. If you can solve in your own mind an answer for that, you will be right. But you're going to have to look very hard to know. So let me get to my prepared speech. Thank you, Ron and Steve, for inviting me here today. My credentials are limited, and all I have to offer is a different point of view. Sort of blue-collar, non-unionized worker who has labored for 37 years and now finds himself a pension fiduciary. My remarks are from the perspective of one who is involved in the markets to invest, not speculate, whose fiduciary responsibility must weigh the adequacy of the pension assets to supply the real cash needed on a monthly basis to fulfill commitments to the pensioner over the next 50 years. Now that's a mouthful. but it simply means I must know what's real as well as relative if I have any hope of making the right choices among all of the options to invest in offered by the markets today. That reminds me of a Charlie Brown cartoon written about 20 years ago. The cartoon starts with Linus and Charlie Brown lying on a hill looking up at big puffy clouds floating by. Charlie says to Linus, "Gee, Linus, what do they remind you of?" Linus says, "That one looks like Einstein's theory of relativity, and that one looks like the first movement of Beethoven's sonata, and that one looks like Michelangelo's David." Then in the last frame, Charlie Brown lying there, he just has these thought bubbles coming up saying, "Gee, I was going to say they look like a piggy, a horsey, and a kitty cat." Point is, they are both right from their perspective. But the value investor knows the truth of it. Both of them are viewing clouds. Sort of a bull and bear argument. You see, Charlie and Linus are dreaming, and their relative points of view are, in fact, as one would expect of dreamers, different but right for each of them. Now, I have to admit that I am one relatively upset, disgruntled, frustrated financial worker. I was a little nervous with a psychiatrist appearing on my right, but that's all right. 2 years ago, we began a process of reevaluating the risk for our pension portfolios. As a result, I came to the conclusion that an over-reliance on benchmarks is destroying the necessary flexibility to preserve capital short-term and potentially long-term if bad decisions were made during times of market stress. The problem is the increasing corruption of the benchmarks themselves due to both volatility and the recurring changes within the benchmark. In other words, the system is becoming too reliant on relativity, with most, if not all, absolutes ignored. For pensions which must deal in terms of absolutes each month and for years to come, the situation is close to a crisis state. Benchmarks have become an easy way to explain the market, but markets are complex. Too complex for a simple explanation, no matter what the discipline. They are an oversimplification. Benchmarks can lead you to the conclusion that the loss you've just taken isn't so bad relative to the index. Although, think, it's still a loss, and losses are real. Benchmarks are a reflection of a bullish past. We cannot duck the responsibility for making decisions as to what could happen. Measuring into the future is difficult. Equations have limits that have historically stayed within ranges. We hear a lot about everything reverting to the mean, except for one thing. The mean depends on when you begin the measuring point and end the measuring point. In other words, you can prove anything. So how do you know which mean? Your measuring point will be different. The risk is evaluating what excess you can stomach before you die or survive. At a pension fund, you have real numbers and real people. You have to decide whether you have adequate coverage. Adequate coverage is not 1.0 or 1.5. Adequate coverage is at least 2 times that pension fund obligations to its participants. Today, our fund has 2.3 times coverage up, by the way, from the first of the year. A bad market could bring us down to 1.0. But let's say we were indexed at 1.2. Bad market could bring us down to 0.5, and if we make that wrong decision to sell at the bottom, it will take a very long time to recover. So our search for value is avoiding the complacency that leads to the belief that you can't beat the indexes. Relying on benchmarks exclusively forces us to live in a past-present tension. We are headed for a reversal, a correction in the market. I hope I'm wrong, but the seeds of a panic are in place. Massive excesses caused by a series of items that cut across the number of disciplines are reflected in the market. These excesses have got to get worked off. They are based on assumptions that have become unreliable. Most of these assumptions are not questioned. We make too many assumptions using hindsight. Some of the excesses that I see. Too much leverage in the system by models which don't think. Selfishness, complacency, and road rage. Money managers who live by benchmarks even though they know they won't work. Spirituality that has been replaced by money worship. Stock options that dilute ownership in a company. Greenwich home prices. Our desire to control everything. Presidents who fool around and politicians who tell us what opinion polls tell them to say. Excessive market multiples, and last but not least, marrying yourself. Markets are a reflection of society. There's a lot of attention being called to the market's bifurcation. Is the market overpriced? Yes and no. Is the market insane? Yes and no. Is there opportunity in the market? Yes and no. Working the differentials will be the key to survival, not looking for the freaking correlations of the past. In order to find the absolutes, you have got to identify the differences between the similarities and account for them. And when we identify the differences, we get a better appreciation for the reality of the fact that everything is linked, not rigidly joined, but linked in a universal connectedness. I would like to put forward an idea today that I probably need one of those jury journals rather than a breakfast meeting to announce, but here goes. I would like to offer you a framework for reality. During the last year, I've had to ask the question, how do you find value in a financial world living on relatives? I would like to put forward my solution in detail, but I have been told that I do not have enough time to do so. I will just say that the answer is that CE equals reality, either relative and or absolute. I have provided you a brief one-page explanation which is available outside, which also includes the modification to our basic math to include algebraic expressions of change and a guide marker to establishing when, how, and why. CE. Reality replaces illusions and delusions. I mentioned earlier that there would be a correction caused by a number of excesses built into our society and markets. All change in society is impacted as individuals make choices both rational or irrational. But you see, those choices ultimately must include truths that are not contrary to natural laws and orders which do exist. All excesses taken to unjust, unsustainable places self-destruct if they are not reduced in time. In market terms, I am describing a panic. The landing from this bull market's excess, which can be traced most easily from 1948 to 1999, is going to be very difficult. It does not have to produce a panic. The actions of individuals will be the determining factor, not the actions of the Federal Reserve or any other institution. We are about to enter a market period where the emphasis will be focused on a search for what is real, not the false hope of a 500 multiple for the likes of Yahoo. A great search for value is beginning as the markets bring down excesses both plus and minus of this bifurcation of growth we are about to get in education. There is much room for hope. The key to survival will be the ability to adjust continually and harmoniously. Survival will be the recognition of a mistake before the mistake consumes the value of which it was intended to construct. I'll stop here and I'm open for questions. Thank you, Ron.
Well, thank you. Any questions or comments? Yes, please.
I've got one question for Dr. Shiller. This goes back to the early part of your comments. If somebody has a house and it increases in value from $100,000 to $200,000. They have a stock portfolio that increases in value from $200,000 to $400,000. Why is not that increase in value counted in savings? I mean, economists, I think, are the only people who don't regard an increase in net worth is putting them in putting the investor, the individual, in a better position, perhaps taking a little bit of heat off of the need to save a portion of income at that particular time.
Yeah, this is an important issue right now because the savings rate in this country, as conventionally measured, is about zero. Personal income, the savings rate is defined as savings divided by your personal income minus your consumption. But if you added, personal income does not include capital gains on stocks. If you added that, we would be at record high savings because the amount of income that people have gotten from the stock market is typically like 30% of your income. So we'd be saving something like 30% instead of nothing. So the issue is, of course, whether we believe these stock market increases are real. And if you take the efficient markets perspective, which would say they are real, then I think you're right.
How about housing prices? I mean, it's all in there, right?
Yeah.
It's all in the...
But I don't think these things... See, incidentally, saving is really not... The behavior is not one of low saving if you take account of capital gains. However, there are dangers to assuming that these are real. But I'd like to stress.
Can I make one point? When you look at stock prices, the real value is established the day you sell it. When you look at housing prices, the real value is the day you sell it. In between is a relative value, just as in the market, floating back and forth. Value is reflected by an absolute action at the time you take it. So to reflect that, I think it should be in there in some formula. Not ignored, but it needs to be in there also. So we need to find a way to have a little flexibility so that you account for it, and also maybe people pay more attention to it.
My point is things may be a lot better than they seem.
They may.
Reality will tell.
Well, there's no question that, again, and going back to the interviews that I've done, that baby boomers are saying my savings are in the stock market. And the subjective experience is that people assume that their stock market is the savings. And, I mean, I agree that it needs to be in there somehow. I don't know what the formula is for doing that, but it's not being taken into account in the current ways of figuring savings. And it does need to be, not in an absolute way, because there's too much variability.
But the danger for the individual here is that he puts too much of his savings into the stock market, and it becomes unbalanced within his total portfolio of his personal real wealth. You got a house, you get this, you get that, that's fine. It's a balanced situation. The other fact, I don't run too many surveys, but I tell you, most people really don't like to make decisions day to day on stock market because they can't pick stocks, and right now you've got more mutual funds to pick than you have stocks. So how do you make that decision unless you devote full time to it? And most people really don't want to devote full time to that asset. I know I don't.
First observation and a question. Yesterday I was at a meeting at Thomas Smith Barney with the chart room down shore of premier technicians in the country. In a room about half the size of this, you have all across the wall footprints of stock prices going back 50 years. So I was wondering if Dr. Shiller, if you'd taken into consideration behavioral footprints. What do you think from the technician, the stock market technician? It's interesting from a behavioral point of view from different cycles. So that's an observation. Secondly, another well-known author is Harry Dent. And Harry Dent talks about demographics being destiny. I was curious in your work if you had looked at the consumption, savings, and spending patterns at these points, 1901, 1929, 1966, and how that was that a precipitating event? How does demographics make it different this time?
Okay. Well, first about technical analysts, I think this is one of the I remarked earlier about the division of academic disciplines. Technicians have almost no interaction with academic economists. In the classic book, A Random Walk Down Wall Street, Burton Raphael says technicians have been discredited by careful scientific research, but he didn't give any references to that. So I met him once and I said, where are the references? And he said, I was just referring to economists' tests of the random walk hypothesis. But economists have hardly ever tested what technicians do. There's a few papers, and they do suggest that there is something to technical analysis. But technicians, I criticize them. They could do a little bit more statistical evaluation of their methods than is customary. Harry Dent has written a series of books starting in the early 90s with titles like The Roaring 2000s. They're all based on the baby boom. And his theory is that baby boomers are saving a lot investing in stocks because they see their retirement coming. They're bidding up the market. The market will continue to rise until 2008, at which time it will fall. So you can become very rich now, between now and 2008. I think that he's too precise, that he's got a point. The baby boom has encouraged, if you define saving your way, we're at high saving. See, the way it happens is they bid up the market, and so they think they're saving, but the question whether it's real, put that aside, it seems like the baby boomers, that's one of my 12 precipitating factors. If you want to look at other episodes in history, how reliable are demographics in explaining the stock market? We had a PhD dissertation 2 years ago at Yale that looked at many different countries and different historical episodes. Ji Wu Chen is a professor at Yale that studied this extensively. It appears that demographics explain a substantial part of stock market movements, but it's not the whole thing. And I think Harry Dent exaggerates a bit.
This question is for Dr. Shiller. In your research in past market cycles and investor psychology, how long and what would need to happen to change the current investor psychology that buys in the dips? It took a long time for the investors to see there was a bull market. Now, how long can this last?
That is the fundamental question. It's a very difficult one to answer, too. It seems to me that this buy on the dips is ingrained in people's thinking. It's developed over a decade or more. It's especially prominent in younger people's thinking who have not experienced the early market, and the younger people are the future. So that suggests that the market might be staying at this level or even going up for some time. And at this point, in judging that, I have to fall back on really broad judgment from the broadest perspective. It seems to me rather likely, however, that in my book, I only give long-run forecasting, because that's what the most important question is the long term, 5, 10, 15, 20 years. And I can't say this with any great assurance, but I would believe that over that span of time, this confidence will erode. The high market is partly because of the buy on the dips. It's partly because of exaggerated attention to the market. It's partly due to many of the factors you discussed, feelings of self-esteem, anxiety. It's kind of an emotional set that drives the market into the high position now, and it's kind of the thing now. And that over the space of 5, 10, or more years, we will forget the mindset that we're in. So there will be a gradual erosion of this feeling. And the buy on the dips is partly due to the feedback, because we've already seen the buy on the dips.
Can I interrupt for a second? Yeah. Frankly, the buy on the dips has been around since time immemorial. It's been, you could say things fading in 10 years. Buy on the dips is nothing more than buy low, sell high. What we've forgotten is the selling. What we've forgotten is the evaluating short term because of the excesses that are currently in place. And I am nowhere near as pessimistic as you are about the next 10, 20 years. First of all, I don't think that it's a one-term decision in the market, that it's the long term that counts. If I've got an 85-year-old who needs something for an operation tomorrow, it's today's price that counts. If the market is much more diverse than all of these special discipline studies are showing, both parties have admitted in their own academic settings they don't even talk to each other between history, psychology, and everything else. I would point out some of us do. No, well, I'm over it. You put it up that way. But let me point out something. They are talking to each other and don't know. You know where they're talking? They're talking on the budgets that university set, so money's talking. And secondly, the mathematics are talking because they're using all the same mathematical formulas. And I'm proposing here today that what's needed is a way to integrate, without destroying both rationality and reality, into algebraic expressions for change. Change takes place over a significant period of time, not instantaneously. It's not TV. And it is relatively easier to recognize the changes that have been occurring but are not yet perceived, because it's the perception, recognizing change that has already happened, that in fact shows CE.
Unfortunately, we're running out of time. We need to wrap up early today. I want to hand it over to Steve for a few comments.
Thanks, Ron. I'd like to thank Todd Dersh for helping us pull the panel together. Thanks, Todd, very much. And say hello to some newcomers to our group. Mr. Izumuni from Tokyo.
Actually, he couldn't get up in time.
Okay, thank you. Thanks, Joe. Ed Vassar. Alex Palik, welcome to our group. Michael Murphy and Mike Hogan, welcome to the group. Bill Raver, Bill Creeran, founder of Valuation Associates. Bill, he just left early. And finally, Rosemary Sacranek, welcome to the group. With that, I'd like to welcome everyone out there who may be watching this from the perspective of the webcast with going through altbest.com. Please join us again. Thanks, Ron.
Just to wrap up very quickly, again, thank you to Altbest, Jeff Tanner, for serving as our sponsor for the Greenwich Roundtable. I did a quick bit of research in preparation for today, discovered that one of the first people to articulate the basic theory of behavioral finance, Edgar Allan Poe, who once wrote, "All that we see and seem is but a dream within a dream." I hope that our panels today, I thank very much for their comments, who have given us a wake-up to work our way around the dreams and find those realities to guide us as investors. So, thank you all very much, and thank you, panelists.